Hey guys, it's Big Mike, and like always, I'd like to thank you for being here today. Today we've got Market Delta back with Anthony, and he's here to talk about using order flow for better entries and exits. This is part of our entire month of very special webinars for our 4-year anniversary. We actually have 16 very special events all throughout the month of June, and in each of those we're giving away some really fantastic prizes, including in this webinar an iPad mini, some free months of access for Market Delta's trading room, which is run by Anthony, and an autographed copy of Profit with Market Profile by Dr. John Kepler. So those will be given away at the end of this presentation. Some of the topics for today include understanding the why and how of order flow, recognizing order flow patterns, identifying the trapped traders in the marketplace, and using Market Delta's footprint chart to find those entries and exit points. So definitely pay close attention to what Anthony has to say today, because the quiz questions at the end of the webinar to give away those prizes will be directly based on the material covered today by Anthony. There is going to be a Q&A, and Anthony has said that you can go ahead and type those questions as we go along, and we will pause every now and then and try to take a look at the questions that are relevant to the material that Anthony is discussing and get those questions answered before we continue on. As always, the webinar is being recorded, and I'll post the recording on BMT sometime tomorrow. I'll also post it on YouTube. If you're watching it on YouTube at a later date, do me a favor and please give us a thumbs up if you like the video. Okay, and with that, let me turn things over to Anthony. All right, Anthony.
Thanks, Mike. Let me just do a sound check. Everybody see my screen and the audio?
Yep, we can
Sounds
hear
good.
and
Thanks,
see.
Mike.
Thanks, Anthony.
I just tested through you. All right. Looks good. Thanks, guys, for coming. And I think that this presentation, I've had most success with, because it's about everybody's at a point where are you and where you want to go. And I think through my meandering with helping people and really finding out, you know, the answer isn't in some specialty indicator that's going to give you your exact entry or exit. It's in understanding the why, and that's why it's in the description of this webinar. It's the how and the why, and we'll get into that as we go through this little journey here to get to the end, which is the why and the iPad. So all disclosures that I give, even though sometimes not necessary, I think it's important. In order to manage risk, you got to know what risk is, and I talk about this to trading room guys ahead of every webinar. It's important. It's a lot of legal language, but what's important about it is you have to manage your own risk, and you got to know what it is in order to start managing it. So a little bit of what we're going to get out of the next 30 minutes, 45 minutes, and then like Mike said, we're going to open it up to questions, is understanding the most critical element and probably the most elusive one, and that's order flow. This is the journey to the why. This will answer the question, why do markets do what they do? So a couple slides, we're going to know the why and the how, or when you know the why, the how becomes easier, is how that's read. Know the why and the how becomes easier. Order flow becomes the why. I talked about this in a previous Big Mike webinar we did a couple months ago, how to track buyers and sellers, and it resonates with people. It can't be shown enough, because in order to know that, to have safe assumptions that these are in fact buyers or these are in fact sellers, you have to know why they're considered that on the footprint in order to begin to read and watch them. And then lastly, trap traders, because this is what we're following it for. Again, this is why markets rally and break. It's not people opening up new positions, it's closing losing ones. And that is a phrase I say in the room. It's a phrase I say in any webinar I do. Markets move, not necessarily people opening up new ones, but closing losing ones, or closing ones where the profits begin to diminish. Show this slide a lot. Education saturation is the phrase I give for it, and that is, this is actually, I put had someone put these methodologies in this sign. I think a lot of people get into this business, unlike I was fortunate enough to get into it, and other guys that I grew up through the floor, and that was I was around successful traders. I knew what they were looking at. I knew what the edge was. And I think a lot of people get into this business, and it's not like being a doctor, a lawyer, or accountant where you know what path you have to take to succeed in that profession. It gets to this road sign. And the footprint market profile. I'm not a market profile aficionado, but I do know enough about it to understand and help me create a bias. The footprint is the tool simply I use to read order flow. And we'll get into that later. But I think this sign, when I popped it up to room guys a few months ago, several months ago, it resonates with people. I think it's what a lot of individuals face when they jump into this business. A little bit about me. I'm not going to bore you with my bio, but I've been on the floor as a clerk from 96 to 99. I'm a Board of Trade member. That's me in the upper right. Prop firm trader, April 2000. Been trading on the screen for 13 years. That next picture is the floor, the Eurodollar complex, when everything was on the upper trading floor, lower trading floor at the CME. I was back there in this little grandstand watching this options pit. So that's my background. That's my workstation. That's kind of a little bit about what I do and how I do it. But again, I think what's going to give me credibility is not what I've done, but what I say and how it resonates. So let me give you a picture and make this a little personal to everyone to kind of underscore the passion that I have in trying to convey to people is it's the why, all right? The slide is blank. I've got 4 kids. Why do children, the most popular word out of kids' mouths is why. It's at our core. We want to understand it. And I think too many people want to know how without understanding the why. And I'm going to explain it. And this is why it's important to me. This is a picture of me and my dad here on the left, me here on the right. Why do I bring this, and my 4 brothers in between? Why do I bring this picture up? Because my dad told us growing up, if you know how, you'll have a job. But if you know the why, you'll be the boss. Now, that's not his. He didn't coin that phrase, but he always would resonate. That would always resonate with me because it's in this business. If you know the how, you think you'll make money, but you won't. Knowing the why is essential. And I added this text. If you only know how to trade, you'll think it'll lead to success, but all you'll end up doing is donating. That's why if there's one thing everybody in this webinar today could agree to is the fact that most people who try to trade donate. Why? Because they know how, the functionality, how do I use this dome for that, and this plugin does this, and I'm looking at all that. And they don't understand why markets truly at their core move, okay? So who will you donate? Not you specifically, but overall to those who know the why. All right, so the why has to resonate in anything you do, but it is essential. You cannot know the how and have a job in trading. You have to know the why and be your own boss. So I'm going to walk through a slide that shows Market Delta Trader, and I'm gonna split it in the price ladder and then the footprint that is next to it. So right now I'm just going to go off the price ladder, and we're going to use Big Mike as an example, if you don't mind, Big Mike. We're going to use Big Mike as an example and a guy who wants to come in here. And we touched on this in a slide in a webinar we did a couple months ago, and this is important. For instance, I got to go and use the pen here a second. For instance, Big Mike, he trades and he gets aggressive at times, which is good. We like that. And this is just an example of when the S&Ps were trading 1491, 93 quarters. It should be easy to understand that 93 quarters is where everybody wants to buy it. 91 even is where everybody wants to sell it. Big Mike wants to buy it and he doesn't want to wait. He's going to be aggressive. And he's going to lift 700 of these 751 contracts. Knowing that the price is 91 even offer, seeing 700 print in the footprint, which I'm going to show you in a moment, and with everything else being equal, what would this 751 look like? It would look like 51 because Big Mike just scooped up 700 of them. How do we know Big Mike is a buyer? Because the quantity traded happened when the price was offered. I'll say it again. The quantity traded happened at the price when it was offered. Get away from worrying about who sold it to them. It's about following the aggressive players. Example I use over and over again, the aggressive players are the ones that are going to give us the best chance of knowing and predicting what's going to happen. Guy driving 100 miles an hour down the expressway, it's a pretty good guess something bad might happen to him, right? Aggressive players are often where the tell is. But you got to know why they're aggressive based on this example, and we'll build on it as we go through this down this path. So Big Mike just bought 700 contracts at 91 even, right? We know that based on the price being offered. Furthermore, now Big Mike says, you know what? I was wrong. I got to get out. I only want to lose a tick because Big Mike's good at managing his risk. It's one thing he's really good at. So he buys 700 at 91 even, and he says he sees something and he wants to spin out of them. Maybe an hour later, maybe 5 minutes later, maybe 5 seconds later. So he sells 500 of them at the bid. So he hits the bid. Well, what's the bid here? 90.75. So if he just sells 500, with everything else being equal, this 599 is going to look like what? It's going to look like 99 because Mike just sold 500. 500 are going to appear in the footprint over here on the left that I'm going to show you in a moment, and it's going to represent 500 aggressive sells. Now we don't know it was Big Mike that sold it, but we do know that there were 500 aggressive sells because they happened at the price when it was bid. Now this might be elementary to some, and it might be advanced for others, and it might be somewhere in between for the others. But what matters is if you don't know how you're able to gauge aggressive players based on where a price is bid or offered, then everything else is more difficult. So let's add, let me get rid of some of these drawings for us. Let's add the second half of the story, and that is Market Delta's footprint running right into the price ladder, all right? And this is a collapsible function, right? So it's attached right on to the price ladder. You could open it up, collapse it to save screen space, and such. So I'm not going to get into the functionality of this particular order dome or order entry product, but what it actually is showing you. Inside the footprint here, and let me go back to the pen, it's going to represent what Big Mike did. When Big Mike bought 700 at 91 even, this number here, 1045, is going to look like 1745. 700 more aggressive buyers. When he sold 500, this 26 right here is going to look like 526 to represent his 500 aggressive sells. Make sense as we roll through this? Now Big Mike is still long 200, and he forgot he bought 700 and sold 500, but he still thinks the market's going to wake up tomorrow morning and hopefully see the market 10 points higher, and he's still long mistakenly 200 because he bought 700 and sold 500, so he's long 200. Now all of that has to make sense to you. Where are you when you buy 7 and sell 5? You're long 2. What do you look for to get out quick? A bid. Now I say that kind of fast, but that has to resonate with you and be able to say it back to other people. And that's how you walk yourself through how to locate aggressive players based on where was the price, bid or offered. It's simple. What's simple is the fact that all these guys in blue want to buy. All these guys in red want to sell. All these guys in the footprint actually did it. Aggressive players. Okay? And again, this is Market Delta Trader that's showing you both. And what do I mean by both? And let me come in and out of this. Oops, real quick. The footprint, or I'm sorry, the dome on the right is the how, and the footprint is the why. If you just knew the functionality of a dome and some charts, you might know the how to trade. but you don't understand the why and where these aggressive players are coming in and out. Now we're going to build on this. It's not the end of the webinar just in here. But you have to understand that it's not just fair to assume, it's absolutely correct to assume aggressive buyers and sellers. Lift the offer, aggressive buyer. Hit the bid, aggressive seller. Just in the example with Big Mike. Let's go to slide number 2, and I'll also erase these drawings. Here's a picture of, and people say, well, why are you showing a picture here of a guy, it's coming in and out here, of a guy that looks like he wants to run over these 4 women. And this is something guys in the room call Anthonyism. It's not about what a market should do, but what it should do and doesn't. What should happen is the question you have to ask yourself when you're understanding order flow. It's first the recognition of a big buyer or seller, and then secondly, what should happen when you see that big buyer? What should happen when this guy is running into these 4 smaller women? Should barrel them right over, and that's fine. But what if it doesn't happen? Then what? That has to begin to resonate. It's the recognition, and then it's the question, what should happen next? Now let's build on that. Let's build on that with, let me go jump a slide here, with aggressive buyers and sellers as shown on the footprint, okay? Let's just split this footprint in 2, and this is just 1 bar. Let's not assume, but show buyers on the right and aggressive sellers on the left. That's what this footprint is showing, correct? So when Mike comes in to buy whatever price he wants to buy, and if in this case the price is 03 even offer, and he does it for 437 contracts, that's when it would show up on the right-hand side of this footprint. If he sold 1,247 contracts at the price lower, it's going to show up on the left side. So the footprint always gets split into 2, with aggressive buyers being on the right and aggressive sellers being on the left. Now, to save a lot of anxiety, there isn't a lot of analysis you need to do at every single price level. In fact, save yourself time and anxiety and realize that it's about where things stick out. Everyone has a real good sense, in my opinion, of the ability to create a bias and where a market might go based on many of the tools, especially in a forum like Big Mike's where a lot of people are well versed in a lot of products. But it isn't about creating a bias, it's about executing it. It's about, okay, I'm looking for something to happen at a specific price or area. Now how do I see it and where do I see it? And that's where the footprint is going to give you the quickest visibility of either an imbalance of buyers and sellers or just an influx of inventory coming out. Again, order flow. But if you don't understand the buyers on the right, sellers on the left, and what does it mean, then it's obviously going to be more and more difficult to understand what to do with it. So let's go back a slide. Trap traders. And I just get this picture of a line in the sand because that's the phrase I use all the time in the trading room when I talk about where the game might change. Trading isn't about being right, it's about where others are wrong. It's about where these traps are. Like I mentioned to start this webinar, a market, let me draw this as I'm talking. A market will sell off not necessarily because more people are selling, but because more people also want to sell behind it. Well, at some point, all the people who want to sell, when they finally sell it, whether it's to get out of a long or to get short, that's when you bounce. That's why markets move. That's the why in its infancy. Why does a market bounce? Because too many people got short. Not because we all want to get long and hope people come in after us and buy at a higher price. Because we get long and there's a lot of people short and they have to buy. There's always more emotion when people have to buy rather than they want to buy. You're going to always find an advantage, whether it's emotional, subjective, or objective, when you're dealing with someone who has to get out of that Rolex watch or that house because they need the money. when people have to get out of a trade that is essentially maybe a losing trade, that's when you get people coming in after you, buying it, and that's what makes a profitable trade profitable. It's all under the title trapped traders. If you're not looking in the gauge trapped traders, then you'll have trouble consistently executing a bias that you might be right on. You might have, and I get this a lot with people, is I know where the market's going, I just can't, and my phrase is, I can't get on the team, is what a lot of people essentially are saying back to me. Can't execute. And then when I don't execute, this is feedback from people, is they don't execute the first time, they don't execute the second time, they both would have worked, and then they try to execute the third time. That's the worst time to execute. You see it work, and then you try it. And so it's all about being consistent, executing your bias. Market profile, volume profile are great tools to create a bias. Order flow, as shown by this footprint, is the best way to execute that bias. Why? Because here's what we're looking for, trapped traders. We're looking for lines in the sand, which personally I call my alert levels. Now, lines in the sand are also found on certain market structure and understanding context, a lot that I don't want to get into, but lines in the sand is where people get backed up and they either, bulls have to defend or we're going down. Today there were some lines in the sand that the bears couldn't defend and the lid came off and we end up closing in the mid-30s. There's a lot of extra volatility in the last few weeks because of what Bernanke said at his testimony, and it was kind of a fundamental change. The market came off those 88 highs all the way to 92.5 this morning. Before that went to what, 96, 48, back to 92. Now we're trading 36. And the reason for this volatility is the market is trying to digest and it's always getting overdone. Why is the market getting overdone? Because too many people get short and it has to rally. Too many people a couple days ago got long and it has to break. Markets wouldn't move if people aren't getting too long or too short. Markets are like the housing market in 2007 and 8, only every day, every moment. Like the price of housing going up and then coming off, and it took a few-year period to work itself up and work itself back down. Well, that's a market. That's the S&P minis. That's crude oil. That's gold. That's the Dow. That's the NASDAQ. It's just happening moment by moment, and it's trapping people who are too long, makes a price expensive, and when you're too short, makes a price cheap. So I don't want to spend too much time
on
Anthony.
This slide. Sal has a quick question. He's asking, what's the difference between aggressive buyers and sellers versus passive buyers and sellers?
Aggressive buyers go to the passive buyer, or I'm sorry, aggressive buyers will go to the passive sellers. So in the case that I made before, Big Mike, you were what? An aggressive buyer. And if I was looking to sell it to you at my price, I'm passive. So when you're selling it, you're patient, and you're selling at your price, you're passive. When you have to go to someone else's price, you're aggressive. And so I want people to get out of the mindset of every buyer has to have a seller. Because while that's true technically, there's so many different reasons why people are buying and selling and matched up that what matters is when the short or medium-term guys get collected too long or short. There literally are thousands of reasons why someone might sell you 10 contracts and you're long. They might sell you 10 contracts, Mike, because they just hedged it in a 6-month strategy by offsetting a spread with a put option. It has nothing to do with what they're going to do in 5 minutes. But you being long, especially if you're long aggressively, is going to affect the market in 5 minutes because you're long and now you're a seller. So I want people to get out of the mindset every buyer has to be a seller and it's a zero-sum game. There's too many reasons why people get in and out, and it's the aggressive players we want to look for. Passive are important, but hopefully that answered Sal's questions about, passive is selling it at your price, aggressive buyer is buying it at the seller's price. Is there any other questions, Mike?
There is one from Charles. I don't know if you'll want to answer this right now or not. He's asking, what if the liquidity is on the ask and price keeps trading lower, or vice versa? What's going to happen when this happens, or what's going on when this happens?
Well, it's a real subjective question because there's a lot of context that is being left out. For instance, what's happening coming into that? Is it a previous order flow point for me from the day before, from a week before? What's the context? Is it coming off 4 points? Is it rallied into it 4 points? Right? What time of day is it? Is it coming off for fundamentals or not? And so if you just look at it for that moment, with everything else being equal, if a market rallies into a situation where there's a lot of liquidity on the ask, then I'm thinking that guys are getting stuck long. We just rallied 4 points in the ES. A lot of people are aggressively buying, and someone's got their hand up saying that's it, no more, potentially. All these aggressive buyers are long, and they're wrong. And what happens, and I'm going to cover this in a slide or two, what happens when you're long? What are you? A seller? And that selling pressure creates a move lower. So I think, Charles, that answers your question. There's always a lot that goes more into with context, and I'm going to cover it. I think it's a good question because it lines up with some of these next few slides. All right, so we covered the second one. This is a slide I put together that I think you guys are going to like, and it's just kind of off the heels of Charles's question. When you sell and you go short, what are you now? You're a buyer. That's pretty obvious, or it should be pretty obvious, and I don't think it is. This is something that I've taken a poll off of room members, and something that resonated with them when I say, well, what is it that when I take you through the whole process of learning order flow, what phrase or helps, triggered something? And it's like, once you sell, you now are a buyer. Once you sell to get short, you're now a buyer. Well, if a lot of people sell and get short, and a lot of people are short-term traders, there's a lot of buyers coming to this market. So every circle, every hollow circle is a seller, and it is tipping the market lower. And then all of a sudden, this big seller comes in. And we look in and we say, is that enough? When is this selling going to reverse and either become exhausted, or when do all of these round circles now become what? Because they're all coming back to the market buying. They all want to buy the market lower, because when you get short, you need prices to go lower to be profitable. But you're still a buyer. If the market doesn't go lower, you're a buyer at a higher price. And so when you get that big guy come in, like here, and I'll show it again, when you get this big guy that tips the scale, you also end up getting some littler guys come in, sell it, sell it, sell it, sell it. And all of a sudden, price doesn't go. What tips and forces the market to bounce? And a lot of times it's one guy, and I got a filled-in circle of a buyer that comes in and says that's enough. And all of a sudden, all those guys who just sold it on the previous slide, they're buyers. And they're buying, and they're creating this market. And I have to illustrate it with a pen. They're creating, if you just look at this scale and this platform, it was down here, right? And now it's up here, because all of this pressure of people that don't want to buy, they have to buy, because they just sold it and price didn't react lower. That's order flow. That's the question, what should happen next? We had a big seller that came in and the market didn't go lower. All it takes is for a little bit of buying, and the next thing you know, all the sheep follow and all the shorts got to cover. A lot of shorts have to cover. You don't want to be short with them. In fact, you want to be long before they cover, and that's what makes a profitable trade profitable. Can't say it enough. That's the why of trading. That's what creates markets to rally and break. And when they're more volatile, there are more players getting stuck. That's what's happening the last few weeks. There's more medium and longer term interest in positions being taken and exited because the market was given a game changer by the Fed and backing out of QE3. That's why we went from 88 to 92, now to 36. It's continuing to get overdone until it settles out and finds value and digests the Fed's new stance, right? And I'm not an economist, but I understand that event better than an economist when it comes to trading, when it comes to what's going to happen next. You know, I got essentially I've done this my whole adult life as being a trader, and I got a big family, and they come and they say, well, did you see what's going to happen in this stock? They own a lot of it. I said, I don't have the first clue what's going to happen in a certain stock. It's a whole different mindset. All I care what's going to happen in the next 10 minutes, 20 minutes, half hour, and go from there. Make it easier on yourself. You'll get better at predicting what's going to happen in a few hours, but first learn to predict the present and then back up from there. So many people look at static charts, candlesticks, and the history, and profiles, which are important, but they neglect the present. The footprint's the present. This dynamic of the scale tipping, and a scale has to tip in order for a market to bounce, it's missed, and it's the why. It's the answer to why markets would have went down. You got this abundance of selling, too many short-term traders short, they have to buy, and then it rallies out of the hole. And I could go over and over and over this again, and there's more people that don't know this dynamic, and I think once once it becomes more front and center, they come to the realization, and I think it becomes an eyebrow-raising moment. I think that's what's important in anyone's career. And I'm always learning. The learning I do, there's two pillars to this business: order flow and market relationships. The learning I do is to what market is helping and influence the market I'm trading. And I'll give you guys one. The yen has helped me the last few days because it's key. I've been able to key off of that a couple times. When it's weak, S&Ps are strong and vice versa. That comes in and out of vogue, but the point is market relationships are like comparing car dealerships to each other, and order flow is like watching how many buyers and sellers there are for that car. That's it. We're trading price, and anything with price attached to it adheres to those two concepts. They don't have to adhere to a moving average Fibonacci stochastic oscillator cross. The last time you guys bought a car, did you go in with a chart of a moving average cross to try to get the salesman to lower the price? No. You went in and said, hey, the dealership down the street's $2,000 less. Beat them and I'll buy it. You didn't go in there with a stochastic. You went in there with a simple comparing and contrasting model. We touched on that in the last Big Mike webinar, I think, and again, it goes back to the scale tips when too many people, in this case, got short and it needed to rally. Let me erase these drawings.
Anthony, before you change the slide, Gary's asking if the buyers and sellers on the seesaw are the aggressive participants that you talked about earlier.
I'm going to show you it in the next slide.
Okay.
Who is this again, Mike?
Gary.
Gary, another good segue question, because in the next slide, again, like I prefaced, I want to see aggressive players because they're the ones that tend to get stuck quicker and highlight better entries. Someone said, well, what's a more important price, an entry or an exit? And I said, they're all important. Anytime you risk money, everything around that is important. Right? Anytime you're risking capital, everything is important. Your entry, your exit. Which one is more important? Sometimes the entry and sometimes the exit, right? Don't try to quantify it. So aggressive players usually get in and they're late. See, what happens is just the human nature. Someone sees a market. Let's use the ES, for example, because I think it's the most popular market out there. It breaks 4 points. It's a pretty nice move in the ES, right? Well, people see it. It was here. Now it's down here. What does everybody want to do? They want to sell it. They don't want to buy it. And you should say, I want to buy it. Now, it doesn't mean you buy it, but after a market moves 4 points, and that's considered a big move lower, I say to myself, well, I'd like to sell it, but too late. Should have sold it up here. So I'm not going to sell it down here and be a sheep to the people who sold it better than me because they're looking to cover. So to answer Gary's question, I'm looking for a tell that everybody who sees this go lower, they get anxious and they chase it. And maybe they chase it because they see it go lower and they think it's going to continue to go lower with momentum, or maybe they chase it because they're long from up here, going back to markets move because people are getting out of losing trades. They get long from up here and they finally sell it for their loser down in here, and then you get someone coming in and selling it aggressively on the selling it aggressively on the bid, that's where I want to buy. I don't want to sell it with an aggressive seller after a 4-point sell-off. That's where context comes in, the context that we just moved lower. So I want to see an aggressive seller followed by other aggressive seller get sucked in. The market absorbs it. That's the market waving its hand to say, buy me if you're bullish. If you're already bullish for whatever other reason, that's when you qualify the buy. That's the order flow. There's probably a lot of volume and market profile guys in here, right? So when you're saying, well, when do I know to buy an LVN or HVN or play, support resistance? Right here. This is how you qualify and execute your bias. If you had an LVN notch or a naked POC or any host of reasons why you might have support, and you see this dynamic, a 4-point sell-off and a big seller, that's take a shot. That's order flow. And then manage your risk. The difference is people always want, they want to see an LVN. Let's just use that for example. They want to see every LVN ever work. And if it doesn't work all the time, they want an 80% chance it's going to work. So then everybody could do the math and figure out what their income is going to be every day, week, month, year. Well, trading isn't about that because there's so many moving parts and context into that LVN. So you have to qualify it with this, the present. What's going on right now? What just happened? We just broke 4 points. What just happened right now with a 600 lot seller came in and the market couldn't go down anymore? Well, what if I buy and it goes down? Well, that's going to happen too. You manage your risk. The point is, that's how you qualify a previous area or level where you want to get in, and then you become your own indicator. How about that? You become your own indicator instead of having to rely on a system that everyone tries to spit out percentages that it works, and then they get into it and the numbers lie. Numbers do lie. You need to become your own indicator, and the only way you become your own indicator is if you understand this concept of the why markets move. Why will markets move back up? 2 reasons. People got too short down in here, and any of the people that got short down the move lower will start to cover those shorts. Too many shorts here, and any shorts above will puke it and bring it back in. And then people say, well, what if there's more selling and send it lower? Well, that happens too. That's why you can't just buy and sell every big aggressive buyer and seller. You want to have market structure to say you think it's going to stop there. But let's say there's a swing low right there. Well, you guys know as much as I do that you can't just buy off a swing low. But if you think it's going down or you think it could bounce off that swing low and you see this dynamic play out, that's when you become your own indicator. Is there any more questions on the scale and illustrations, Mike?
Well, there's a couple of questions. You can let me know if you want to take them now or later. David is asking, he says 70% of trades are algorithmic and generated in milliseconds. He says large trades get pulled quickly. How does a retail trader make any money in that environment?
70% of trades are what would be considered high-frequency trading is what you're referring to, David. And high-frequency trading, you know what they use to create profit and the models that they built? They use order flow. They're trying to race bigger orders. They're trying to race bigger orders in a big stock that represents most of the ES, or a big stock that that they could pick off and say a big order comes in, they try to race it, and if they're wrong, they get out for a small lose or a scratch or pull the order. That's high-frequency trading. They're playing and trading order flow, trying to follow big orders. And when big orders come in and the market can't go lower, they try to buy the offer as it turns. And if they buy the offer as it turns and it goes bid, they lean back on that bid and they scratch it if they're wrong. And they're doing it 5,000 times faster than the blink of an eye, that they are getting pulled. The orders are not real all the time. That's why you can't mistake volume for liquidity. Liquidity are real risk takers that are there. And these high-frequency machines aren't true. They're not going to buy threes unless they could sell fours. And you say, well, how are they guaranteed that? Well, they're not, but they're so fast that they're buying threes when they turn and go bid, and they're working the fours, and if they can't get the fours, they can hit the threes. But they're watching and programmed to look for all the other correlated markets. So the last part of your question, David, was how does a retail trader make money? And number one is not to think like a retail trader, it's to think like the professional and just widen your time horizon a little bit. Not as a swing trader, but widen your time horizon so you're not going to compete with a machine for a tick, but you're going to compete for executing your bias. The market's moving. And where do I find this dynamic of guys getting stuck? Where the machines will try to buy it down there because they have it programmed that there are too many shorts in that particular context. So you think like the machine, only don't compete at all with it in the element of speed, because you won't. Elongate your time horizon so that you're able to, not necessarily follow them, but at least create the ability of being a contrarian and create or execute the bias you created. A guy that is a friend of mine that's he gets traded next to me for 5 years, and we were talking about the he didn't realize, because he doesn't have a lot of engagement with the retail audience or educating anyone, and so he's been a professional through the floor in a prop firm environment like me his whole career. And he's like, you mean there's people that aren't contrarians? And I says, yeah, most of them, I think most try to go with a trend, and trend trading is fine, but the good ones will try to buy a pullback. They won't buy through the highs. They'll look for a pullback to buy, which essentially makes you a contrarian. Why? Because too many people got long in here, had to come back. Too many people were getting short in this little pullback. The market was maybe overall bullish, and then you're able to buy it once you find that area where they're stuck. So it's all about recognition and then knowing what to do when you see what you're looking for. You'll never find what you're not looking for. Big guys getting stuck is what you're looking for, and all the little guys to follow, and then executing is the whole game. That's what these machines are doing, Dave. So it's about not competing with them. It's about emulating what they're doing and just widening your time horizon. You got another question, Mike?
There's a couple of comments here. Bob's asking, he says, I guess that moves start as profit taking, and then as price moves, others join in and they become aggressive. He's asking if that's correct.
Right, profit taking by bigger players, medium and longer term traders. When they start to take profits and you build a dynamic, or you cross the dynamic of, let's say a market moves up like this, people who are long start to take profit. What do? They start sucking shorter term players, getting long, and the price won't move higher. So long profit taking is sellers, right? And then when they start trapping the shorter term traders, and then medium-term traders looking for this trend to continue, those guys that are trapped that didn't get satisfied to the upside have to become sellers, and it becomes a self-fulfilling prophecy. Anybody's traded for 5 minutes or 5 years or 55 years knows that after you buy it and get long, many guys often have automatic orders that go in the book. So you guys know it. When you buy it, what happens? You have a sell that goes in above the market and probably a sell stop that goes in below the market, correct? So what if it doesn't go up to your profit target? Are you not a seller anymore? No, you're still a seller. So if a lot of people are with you, then you don't want to be long. And the fallacy is you want a lot of buyers where you buy. No, I don't. I don't want a lot of buyers where I buy. I want a lot of people who are short, and I want to buy it at a move lower. And I don't want a lot of buyers that are getting long with me, because what happens? Every time they buy it, they're looking to sell it slightly above the market. It's going to be hard to go up. So let's go back to this example real quick. If too many people buy and get long here at this pink ball, they're all putting sell orders above the market to get out for a winner. Well, the market's going to have a tough time going up. There's too many sellers above the market. It starts to curl down a little bit. They're all looking at each other in a crowded room, ready to race for the exit. It becomes a self-fulfilling prophecy. Too many sellers, market has to go down. So it's the kind of buyer you want to see. And it's always, when you buy it, you want to see people buying it because they got to cover a short, and they miss it. That's even better. And then they kind of squirm to try to get out. Hopefully that answers your question. Let's go to the next slide and then get some more questions, because I think I'll clean up some of these answers and even some other questions on this next slide. But let me get rid of these drawings. Here's the trap. Back to a footprint. And what I look at, this hones in on a little bit more detail of what I look at. Again, these are images. I analyze this real time for Trading Room guys, as I'm just essentially, the room that I host is just me thinking out loud, is essentially what it is. I have what I call alert levels, but it could be anybody's support resistance. I mean, really, you got to have an area where you start to look to see where you think the market's going to stop going down. It's not where the market's going, it's where it stops going and goes the other way. So where's the trap? Where's this? I could show you scales and other illustrations and pictures, but let's look at a chart and really see this dynamic play out. Now, a couple things. I have support levels where I look for a market and resistance levels to go into and come out of, right? And I have them before the session. So I want to be a buyer and get long when it approaches that level. Now, I have intraday lines in the sand too, but let's just use a level coming out of overnight, coming into the day session, and like, all right, there's support down here. And by the way, my levels are not generated mathematically. They're generated by order flow. They're generated where people are, in my opinion, stuck long or short from the previous day and so on. So this gray area, you can kind of see it between these two pink pen marks I'm making, is support. Well, what do I want to see? I want to see a lot of selling and the market can't go down. Now, I don't know that the market rallied up real time, but what I do know is it's selling aggressively and price seems to have a trouble going down. Here's the other thing I know. It just came from about 3 points higher up here. That's context. I know where it came from and I know what it's doing. That's the present. What happens when a market goes lower? It's mean people are selling and they want to sell more, or wouldn't go lower. When you finally get the people who want to sell is when you want to buy. Markets go lower, why? Because more people are selling, but more people want to sell. If more people didn't want to sell, it wouldn't go lower. It's another answer to the question, why do markets move? People want to sell. They keep offering it lower and they can't. When they finally sell is when you want to buy, is when that selling gets exhausted. But also, those sellers now are buyers. Less sellers, more buyers, where are we going? Up. Again, that's the why markets move. So you could see it in the footprint. The color with the imbalance gets darker red because there's more aggressive selling. You're looking at Market Delta Trader or your price ladder or the footprint to see the price can't go lower. That's the present. I've already have a preconceived notion that people want to, that there's going to be a bounce in this support area because this is where people are going to try to scratch a losing trade from the previous day. But the reason why it's an alert level is irrelevant. Could be a level because it's an LVN you guys use as a volume profiler. Could be a level because you use a moving average across. Doesn't matter. It's a level you're looking to trade in. So my point is that you take this top chart, and that's all the aggressive buyers and sellers in the footprint. The bottom chart is a filter, and that's what the beauty part of Market Delta is, the high functionality of it as a price ladder and as a chart, and as charting software, where you could change and create all these indicators, all these paints on the chart, and then filter it out for these bigger players. Let me erase the drawings. Look at the arrow that I just put in there, I just took out. Put back in. Again, this bottom chart is the same chart. It's just filtered for a couple hundred contracts is what I feel is about good size, good for big size in the ES. All right. context. Do I care that a lot of people are buying and selling right in here? No, for a couple reasons. I shouldn't say I don't care about it, but I care a little bit less because I'm not looking to do anything in here. Plus, it's in the middle of a range. I want to look at the edges and where people are trading on the edges. And what do you mean by edges? After a 3 or 4 point break in this case, so from here to here, plus it's in a level that I think is going to be support, that's when my eyebrows raise and I look, and I often joke about this, at one day I don't even want to look, I just want a hand to come out of the monitor and hit me in the head and say buy it. And that's you being your own indicator. See this big 675 lot? He comes in and he aggressively sells. That's Big Mike. And unfortunately, Mike took it on the chin in this trade. He sold 675 and it won't go lower. What do you think Mike is doing, or anybody else who just sold 675 into the bid and it won't go lower? They're a buyer and they're not getting paid. Now, forget about the fact, well, maybe they're getting out of a long position, whatever. It doesn't matter. If they're getting out of a long position, they're no longer a seller anymore. That's good, less sellers. If they're getting into a short position, that means they're coming back to be a buyer. Plus, it's in an area of support. Plus, there's other guys that are piling on, like in that scale example, and you're going to get this reaction. So when you see these rectangular boxes, which is the footprint, you have to draw a line through them and say the market just came from here. Let me get rid of some of these illustrations. The market just came from this X, broke 3 points, a lot of aggressive sellers, can't seem to go lower. You think it's support anyways. What other indicator do you want? It's all about qualifying your predefined levels. And I think when you practice at, people say, well, here momentum is going to come in. Listen, you have to know why momentum is momentum. And there's another webinar we're gonna give to people as part of being to this webinar. If you don't know why momentum is momentum, you'll never be able to trade it. Momentum's an advanced way to trade anyways. This isn't about momentum. This is about straight contrarian type of trading. People talk about momentum and they look at it and they see someone come in and they're like, well, this is where momentum started. What happens with momentum trading, and it's good to get up to that point to recognize momentum, but you got to know why there's momentum. The problem with trading straight momentum is you'll catch all the losers and miss some of the winners. So you got to be a good risk manager, and you got to know why there's momentum. And momentum usually is coming out of consolidation, let's say, and there's when too many people get short, we're going up. When there's consolidation that looks like this and people say, which way do you think it's going? You know what my answer is? I don't know. The market doesn't even know which way it wants to go. Why would I know? All I know is I start to call buy stops above and sell stops below for different reasons. There's other context involved. But just to keep it simple, too many buy stops, and you want to be long when those stops get triggered. I'm just kind of segueing people into this recorded webinar that we're going to offer in a couple slides, but I wanted to get people understanding that there's this I think there's this holy grail cloud out there that, and it's not anybody's fault, because as a human I look for ways to make everything easier. And the thing is, I think that if you just went back to what we all aspire, and that is to know the why of anything, then you become your own indicator. You really do. Forget about how. The how is always easier, but you got to know why these markets do what they do. And there's no disputing that too many sellers and markets don't go lower, they're gonna bounce. There's a high probability chance of bouncing. There's not a volume profile, market profile, moving average, Fibonacci oscillator, indicator, Gann, Darvas box, Andrew Pitchfork that's ever going to explain the why the markets move. Order flow does. Traps do. How do you get your best deal on a car? If you got the guy selling it needing the money. How do you get your best deal on a house? Because there's 3 of the same houses in the same neighborhood and there's no buyers coming to look for it. You're probably going to get a better price. It's all supply and demand. It's all about when price is attached to something, it adheres to market relationships and order flow. Everything else is secondary and last, find a bias and then execute it with this concept, with these tools, and become your own indicator. You could put paints on a chart, and that's your indicator. It has to do with buyers and sellers. A lot of people with volume profile, it's an excellent tool to create a bias, and the weakness of it is I can't get in and I take too much heat. Location is all about taking a minimal amount of heat. I say this in the room, you're better off having an ugly house in a nice neighborhood or a nice house in an ugly neighborhood. You could be short all day at a nice rally and made money today because there was some nice pullbacks. You could have been long today and lost money because you were in bad spots. So it's not about a bias, it's about what are you looking for, and this element of traps and this element of too many longs and too many shorts. That's what makes a market rich or makes a market cheap. Let me get rid of these. Let me run this acronym. Guy been in the room for a while. He put this together as a way to help him understand my methodology, which is, by the way, the methodology of every trader that I know who's successful. Guys I grew up with, and not grew up physically with, but guys from the floor / then the prop firm, successful prop guys, never been on the floor, and so on. And it's this basic acronym. And what it is creating a bias, whatever it is you use to create a bias. I use market relationships and context and order flow to help create my bias and execute it, but it's creating a bias. It's looking for an area to trade in is the A. It's looking for size or imbalance in a market where guys are getting stuck. And then it's about committing. It's not about looking for every validation on earth that the market's going up. It's not about looking for percentages of probabilities. It's about committing and knowing what to do when you're wrong. Trading isn't about making money, it's about not losing money. It's about being wrong and actually making money. Good example in the room today. Guy came in, sold 10 quarters, made money because he scaled out, took a scratch on the last third, and here we are trading 36 even. And if he told his wife, you know, I sold it today, she'd probably throw him out of the house if she knew what the market did. But then he says, no, wait, I managed my risk and I actually made money, right? Because he knew what to do if the market didn't continue to do what he thought it was going to do. So again, it's about having a bias, having an area, watching for order flow, which is size and imbalances, aggressive players, and then committing. The risk, you know, when you're in good locations, it's easier to manage your risk because you're in good locations and order flow is validating that, right? And it's not a very, it seems like it could be difficult to learn and spot and identify, you know, and I take it back to so does anything when you're trying to learn it. And then once you learn it and make it simple, then all of a sudden it becomes easier. And you're like, wow, I wish I would have started on this before. But it's not a long learning curve. It's what you know. I'm just making it applicable to trading. You know how to find a good price for a house, a car, and a T-shirt. I'm just trying to make it applicable to the S&P 500. That's it, right? Without a lot of smoke screen and mirrors and sell you a trading strategy. It's a methodology. Again, it's buyers, it's sellers, it's comparing and contrasting. And when he put this acronym up here, basic, you know, that's what it is. And it's like, well, if trading is basic and the principles are so simple, you know, why do most people fail? It's, well, because most people don't ever get to this. And secondly, anytime you incorporate the money into what you're doing, all bets are off. Plus, most people don't know what they're doing. All bets are off, right? And so once you understand what actually moves a market, it just becomes easier, right? And one thing I tell people is I don't guarantee people will make money if they follow this methodology, but I can almost guarantee you're going to have your best chance at just stripping out randomness. And that's what you need to do as a trader, whether you're profitable, not profitable, semi-profitable. Hey, listen, it's not hard always to get profitable for a day, a week, a month. Be profitable for a decade and a half. Be profitable for a couple of years. Be profitable for a year. Consistently profitable should be everybody's goal. How do you do that? You have to strip randomness out. You have to say, I knew that was going to happen, and I bought it, and I sold it. You actually made money and attached a trade to your opinion. So that's the why, right? Exclamation point. What are you looking for, and why is it important? What you're looking for are bigger buyers and sellers. Why is it important? Because it's the trapped traders that matter. It's the trapped traders that create emotion. It's the trapped guy who's got a $10,000 Rolex, but he has to sell it to the pawnbroker for $2,000 because he needs the money. Pawnbroker made money, got something cheap. Why? Because he found who was emotional. Just apply it to the market. Just apply it to the footprint. You'll see it. The footprint is emotion. Don't be part of it. Profit from it. There'll always be 90% of the people who lose money in this business. Always, 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 because they'll always think it's easier than it is, and they'll have the blackjack personality of betting bigger when you're down, betting smaller when you're up, and not knowing even some of the skills of the game. It's just it feels good to win money. Well, we're not winning money. I don't, anybody says, does it feel like you're winning money? No, if it felt like I was winning money, I wouldn't be able to do it for long. There's a lack of randomness. I'm not waiting and hoping for a Queen of Hearts to come out. There's a sense of an edge I've built in by seeing where other guys are stuck and reading your players or reading your opponents. And it's easier once you know how to do it, because there'll always be more sheep in this market than shepherds. Always, just based on just human emotion. And this, not knowing the why. They don't know the why. And because they don't know the why, the how doesn't matter. It really doesn't. So I didn't want to get into talking too much over slides. I tried to show pictures and a lot. It's tough to listen for an hour. It really is. It's easier to talk for an hour than it is to listen for an hour. I just hope that there were some common elements to what I said that stick. Though nobody dispute where trapped traders are is the edge. Nobody will dispute that. Anybody who disputes that would then not, probably never didn't make any money, because that is what creates a bounce off a low and a pullback off a high. So let me look at, we're not done yet. I'm going to introduce this, and then I'm going to come back to it. Mike, if you want to, do you want to pop it in the chat window, and then I'll go to the questions for the prizes, and then we'll come back to this and answer all the questions.
Sure. I'll post it on the thread as well.
That have come through as a time. All right. So he's going to post it. What this is, just to kind of give people a sense of maybe, I don't want to say step 2, but the webinar is Stop Hunters. It's part of a webinar series I've done. I just call it Webinar Library. And Market Delta is asked me if we'd offer it to guys who come to this event. So Big Mike is going to post it. Click on the link. For those watching this on a recording in the future, visit sales@marketdelta.com, because the link isn't going to be good perpetually. So if it's not good and you can't copy the URL or visit this, then contact us via email, and we'll see if we can't make it available. Here's the picture, though. Stop, 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 stop. Those are all stop orders. Stop orders, for the most part, are people getting out of losing positions. That's when you want to go. Whether they're stop orders and a cluster of them above a market or below a market, or where they're getting trapped, that's when you want to go. You don't want to get run over by the herd, but you're not. You know where the cliff is. And the way the picture I try to paint for people who have listened to me for any short period of time is, you want to be in a quiet helicopter above a field of sheep, and when they get all stuck together, and you see the cliff, you know what's going to happen next. That's the visual picture you want to have as a trader. And that's how you kind of are a surgeon, looking for where others are wrong. Everyone hates to be wrong. Relish in that. Relish in it. And that's how consistency comes in. You could read books, right? You could read a lot of books, and there's some good books here. We're going to offer a good book on market profile, but most of the books out there, I tell people, take all your books that you might have read about trading and put them in a big garbage can and put it out on the curb on garbage day, and then let the garbage man read them and have him open an account and trade against him. It's the best way to take that information without knowing the why. The how is we'll just create donation. With that being said, there are good books out there, but they all have to come back to understanding why you're creating that bias, and it'll always get back to, if you could find where they're trapped, you'll execute that bias. So we'll go from this page to the question page. I'm pretty sure it's going to be a blank slide. I'm going to ask the question and then go to that slide just in case it pops up. So we'll get everybody ready for this first question. We'll give everybody about 20 seconds, 30 seconds, Mike, what do you say? And then we'll ask it.
All right,
and
so
then,
this is to start. Okay, so this is for the start of the prizes to be given away, right?
This is for the start of the prizes. The first question is going to be for the iPad.
Okay, guys, and I'm going to be asking, if you're one of the winners, I'm going to be asking for your BMT username, so just have that ready for me. Also, I'd like to just quickly mention it's one winner per webinar, so please keep that in mind to keep it fair for everybody.
Right, especially the people watching on recording. They might answer the question. All right, so I'm going to ask the question, and then they're gonna type it in. And in this question, the first person that gets it right will get the prize, and then every subsequent prize will be 2, 3, 4. Mike will explain that. But either way, good. I want to make sure I covered all the answers, or that wouldn't help. All right. So the first question, and then we'll roll over to this slide, Mike, is this: how many contracts do I consider big in the ES?
All right. We already have the answer. You guys are on the ball today, just like this entire month, it seems. All right. So the answer is 200 contracts, and the first person is Melissa S. Melissa, I need your BMT username, please. Congratulations.
All right. The second question, and it'll be the second person who answers it correctly,
right,
to account for speed, will be a free month into my room. So free month into the trading room, second person to answer it correctly. Order flow is one pillar to successful trading. What is the other?
Tricky. Okay, we've got it.
Someone got it.
Yep. Looking for the second person that got it, and that is Abdil Ellis. Abdil, I need your BMT username. So the answer is market relationships.
And that's for the room. And then this one, it'll be the third person who answers it correctly. And it's for a free month for Market Delta charts and getting you set up with all that. Third person to answer it correctly. The question is, what is the tall guy's name in the picture used to describe order flow?
All right, man. Again, you guys on the ball. So we're looking for the third answer. We've got it. Gary NUI, I need your BMT username. So Yao Ming was the answer. So Gary,
someone answered Big Mike. That's funny. I didn't know Big Mike looked like Yao Ming. That's pretty cool. All right, so the fourth question, fourth person answered correctly. There's an autographed copy of Dr. Kepler's book. And the question is, what is the name of Market Delta's dome or platform called?
Okay, we've got it. So the answer is Trader, and I'm looking for the fourth one, which is 2, 3, 4. Derek, I need your BMT username, please. And I'm still waiting for the username from the third person that won. So you can type that in, please. And what was the prize on this one?
$100,000 from Big Mike's book. No, it was the signed copy of Dr. Kepler's book.
Okay. Okay, great. So I've got all 4 winners. So congratulations to the winners. I will get with you after this webinar is over to get the information I need to get that into your hands. Does anybody have any other questions for Anthony? Let's get a second for those to come in.
Well, again, this video that you'll sign when you guys go to this link will get emailed to you. It's a way to look at where you're going to find with a, I don't want to say high degree of probability, where it's going to make sense where others are wrong. And that's the right way to read a chart. And it just ties in directly to order flow and people getting stuck the wrong way. And, historically, people will always use stops to get out of losers. So it ties into guys being trapped. Well, where are they wrong at? So it's a webinar that has a nice fit to this one.
Okay, a couple questions are up. Rudolph asking, what profit target do you usually aim for?
I scale out, and so I advocate scaling for a big reason, and that is so you don't let a nice winner turn into a scratch or a nice loser, right? So, for instance, I look at market structure to get out. On average, I get out of thirds, okay? So I get out of my first third on average for a +2, my second third for a +4 or 5 tick winner, not point, and my last third for roughly 7, 8, 9 ticks, right? So there are guys, though, that, and I don't advocate trading exactly like me. I advocate using the principles that I use to create and execute my bias, right? So there are guys based on personality that could hold on to these trades and locations for 2, 3, 4 points. But what I tell people is start out trying to be right to the tune of a few ticks and then work it from there. Everyone tries to look for 20 tick winners and then realize that, wow, this is hard. Well, of course, the more you look for, the harder it's going to be. End of story. So try to be right consistently to the tune of 2, 3, 4, 5 ticks. If you could scale out, and then work from there. And you'll know how good your location, the first thing that's going to tell you how good your location is the market. That's the first thing that's going to tell you what's good, bad, or okay about your location. But scaling out is important. That's where the phrase, you'll never go broke taking profits came from. It's from guys that complained about taking a 5-tick winner when it won another 5 ticks. Guy probably came up to him and says, hey, listen, it's all about taking profits. And if you can take profits, it's a good problem to have. Then you kind of push out from there.
Tim is asking, how does Market Delta determine what volume is buy side and what volume is sell side? Is it matched to bid offer or by direction of tick or from some flag sent by the exchange?
Bid offer, right? So that earlier slide that I talked about how to track buyers and sellers was if the price is bid, let's just take fictitious prices in a fictitious market. 2 bid at 3. If it's 2 bid, that means people want to buy it at 2, right? They want to buy it at 2. And so if I want to sell it aggressively, I could go to where they want to buy it, and it'll light up 500 contracts if I sell 500 to the people who want to buy it, right? So it's all based on where a market currently is bid or offered that determines, the quantity traded on that price was an aggressive seller or buyer. Because the quantity on that price, people would say, well, there's buyers there too. Forget about the passive buyers in a sense where they have to match. Where they're collecting aggressive sellers is important because the passive buyers are winning out. But when you see the quantity traded, if it's next to a price that's bid, that means the quantity traded were the aggressive sellers. Now, when you take the filter of 200 or greater and see one order for 500 and it shows up next to the price of 2 when it was bid, that someone came in and sold 500. That's important to know. And then how does the market react is even more important. And then did the market come down 4 points and then you've seen 500 sellers? That's when I think of buying, especially if I have a bullish bias in that area anyways. This, again, it's all about executing or else, you could have an opinion and be dead right, but unless you make money on it, it doesn't count. You could tell me who's going to win the Stanley Cup, and be dead right. But if you don't make money on it, being right doesn't count unless you make money in this business. So you want to make sure that you're not executing every single idea or bias, but you're able to execute and strip out randomness and see where guys are stuck in the context of where it came from and what's going on. So I kind of went a little deeper than answering this question. And the short answer is, where the heck is the market bid or offer when the action's taking place? Identifies the aggressive seller versus aggressive buyer.
Right. Several different people asking about the trading room, so maybe you can just briefly tell us. One person's asking if it's run through Market Delta or you. Some other people asking what instruments are traded, what time frame or time of day you're trading, etc.
The trading room is on the Market Delta website. It's Market Delta /trading room, or I could put maybe I'll post the link in for more information about it. My primary market is the ES, and so the way I kind of explain the room to people is I'm using the footprint. I'm an order flow trader, and I use the footprint as my tool to use it because of the dimensions it has, where I could strip out a filter, where I could put it next to a volume profile, and so all the different dimensions I have with that software allows me to read order flow next to what I use to create my bias and then match it up with other markets and relate them to each other. So the room is me thinking out loud is really what it is. And I'm executing trades real time, but it's about the methodology. It's about the webinar library, which the Stop Hunters is one of the webinars in the series. And it just gets people, I'm trying to create a community that just has people trading the right ways to make money, and that is order flow, because that's when you get help. When someone says, hey, look at the yen, like someone did a few days ago, and it helped create an edge for me this particular week. Look at the bonds, look at the notes, they're opposite the stocks. Look at the NASDAQ, look at Apple, look at this big buyer came in Apple and the market can't go up anymore. Or look at Apple keeps making highs but the NASDAQ can't. That's information. And that's market relationships. That's what the room is. It's to keep people privy to really what matters, other markets that influence yours, and order flow. So it's me thinking out loud. I execute trades real time to obviously make sure people know I'm practicing what I'm preaching, but the room is execution, and the webinar series and the in-house webinars I do live for just room members are the education. And I try to balance the execution with the education. Because if I just educated all the time, people would want to see trades. If I just traded all the time, people would want education. And they'd both be right. So I try to create the balance of educating while executing and just hammer across that this is the common denominator among every successful guy I know, and I've been in the business since 1996.
Okay, question from Tim. He's asking, at what point do you conclude buyers are trapped versus being a legitimate breakout?
Depends on the context of where we came from, and if I have anything else there that would say that it's going lower. So context, what do I mean? Let's say, who asked this question? It's a good question. What was his name again, Mike?
Tim.
Tim. This market that I'm going to draw on here is consolidating, right? So I expect a breakout one way or the other. So if I see a big seller, I don't maybe think he's going to get trapped. I think that could be the start of a breakout. So I actually want to play it, if I'm going to look for a momentum trade, short if I see a big seller, and I'm really not going to analyze him being trapped in this particular context. This would be more likely to have that breakout because of context, right? Because what the market's done. If I have a market that's coming off 4 points and it just broke 4 points in a short period of time, then I see a big 600 lot sell order come in, hit the bid, and I already have support or reason for the market to stop there. That's when I would qualify him more so being trapped and take a shot. If a market, you could use it this way. Market rallies and you see a big seller. That's where he's stepping in and for the first time defending prices. That's the line in the sand. So if a market rallies 4 points and then you see aggressive sellers come in, finally come in to sell, that's validating if you're looking to sell it. Maybe you're looking to sell it because you're long or looking to sell it to get short. When you see the big sellers come in after a 4-point pop, that's again the market waving its hand to say, if you want to sell it, here's the guys coming in and defending it with big size, aggressively hitting the bid. So it's all context. And when people come to the room, if you want to join the room, I think we could pop in that link to join it. And it's about the one webinar I think that really resonated with people was one I did about context, right? It was about this. It was about, you know, there are big buyers and sellers in the middle of this range, like in here, in this illustration I'm circling, that don't really matter. You're overanalyzing. Most people will overanalyze, and everybody will be a victim of overanalyzing. I want to see it at the edges. Where do they come in defending, or where do they come in and potentially are trapped? But again, I'm lining up a couple things, not a dozen things, Tim, but a couple things where, and I'll draw on the right-hand side, if the market comes off, and I think it's support down there from a level based on my prep work from the day before or a week, meaning, you know, I think the market's going to find support in this band here, and I see a big seller or a big buyer and a big imbalance. Either way, that's my shot. That's my commitment to the trade, to the execution of a long position. One thing I want to focus in on, and I'm not trying to make this sound easy. I'm trying to make it sound simple, and there's a difference. A lot of people will use, and I think falsely, the more time you put into this business, the better you'll be. And sometimes that adversely affects your results, because in most any other business, yeah, you got to put in a lot more time, and the longer you're at the office, the more results you tend to yield. Sometimes in trading, or a lot of times, you get too committed to a bias because of too much, some people call it homework or prep work or whatever. If you're putting in too much time before you start trading, everything becomes too important, your bias, and you become a board, and you break when you're wrong, instead of being flexible. So I'm not saying don't prepare and don't work. I'm saying be efficient, and knowing that the present is your best way to prepare, and you can't prepare for the present unless you know what to look for when it happens. So my preparation is, where do I think guys are stuck from the day before? That's going to give me my support resistance. What's going on fundamentally quickly in the market when I wake up and see what happened in Asia and Europe overnight? Economic numbers. And that's it. There is preparation I do, there's no doubt, but it ain't an hour before the market. It ain't 3 hours. Again, devalue the importance of each trade, but use the present to help better those entries and exits, because you use order flow both ways.
A couple of different people are asking if you offer any type of course work, any order flow course, or something that they can follow step by step.
Right now, that's essentially part of the room, because there's a webinar library that's offered out, and so that guides them through that. You get 6 webinars at the beginning, or I should say you get 6 webinars as part of your first month, and then every day in the room you're seeing this analysis real time.
Juan is asking about stop placement, wants to know how you know where to place the stop and how big your stop is.
Well, I don't use a hard stop, okay, and not that I advocate that you shouldn't, I just don't. I hover, right? So what I mean by hover is, let's say here you see my arrow on the screen, and it's over a price where I want to get out if it's starting to go up there. I generally, and people, and I wouldn't say this unless I had cooperation from people who have listened to me for a long time, it's very rare I take 3-4 tick losers. I usually try to take -1s and -2s and scratches when I'm wrong. It's rare I take -3s or 4s. But to answer the question outright, my hard stop, if I used one, would be 4. I don't want to have my risk be any more than 4 ticks, and I want my average loser to be less. Now, you know, what people they get into when anybody gets like stuck in a position It's because they didn't have a plan, right? They didn't know where they're going to get out before they get in. I know where I'm going to get out. And it's always I try for a winner, right? We're all trying to get out. But I always think of where am I getting out before I get in for the loser. And I always want it to be at my price or one worse. Not initially. So it's not like I get long at 3 and I'm right away put a stop loss at 2. It's not what I do, a mental stop or hard stop. Not at all. It's I get long, I let the market do what it's going to do, I focus on why I got long, the relationships to the other markets, I let the market dictate whether my entry was good, bad, or okay, and then if I'm wrong, I try to make sure it's no more than 2. So my average is 1.5 to 2 ticks in the ES, not 4. But if I'm dead wrong, I get run over by a train, I don't want it to be any more than 4, and click out there. Now, oh, that's what I want to say. This is the most important thing about trading. If you're learning from someone, you want to hear, and this goes for a forum, this goes for a thread, this goes for, if you ever want to get better at trading, you got to talk about your losers. My best trades are losers. My best trades are -1s or scratches. Scratches is a break even, right? And the reason why that is because it manages my emotional capital, it manages my capital, but I'm okay with being wrong. And people who aren't okay with being wrong will always add to losers or fall in love with that trade. Devalue the trade. A trade isn't a person. It's not objective. It's very subjective, and it's useless. It's just move on and not think too much about your bias, about being right, about being wrong. Have a plan and understand that small losers are your best trades. I don't talk about, I don't go along like in a prop firm environment, someone says, how'd you do today, Anthony? I don't say, oh, I did great. I made X amount of money. Nobody talks like that. That's truly a professional. Might say I did okay, didn't break any records. If you got beat up, you'll talk about that. You'll say, I got slaughtered today, I got killed, I lost this, right? So professionals talk about losers and losing trades, and we don't grope and flex our muscles about winning trades. In fact, we're very ambiguous about winners. And the learning you're going to do ever, whether you're experienced or not experienced, is always going to be on how not to lose money in this business and stay around. There's nothing better than risking capital and hanging around and not losing it. Risking it, but not losing it. And then you'll catch it. There'll be a flicker, there'll be the light bulb to say, this isn't random anymore. I know it's going to rain this afternoon based on your tools, and it rains this afternoon, and you're not surprised.
A couple different people ask me about different markets like FDAX or bond or oil. Any comments on any of those markets?
If you're talking, I don't know if you said the bond or the bond, but the bond's a 10-year note in Europe. The DAX is what I watch. I watch both of them. I don't trade them. I watch them, especially in the early morning hours where the second half of Europe's day is our first half. The DAX and the Euro stocks, two of the more popular stock indexes in Europe, trade pretty heavy into 10:30 Central. That's when their equity cash markets close over there, and that's when our U.S. markets slow down for midday lunch. Not lately, but historically is when we slow around 10:30 Chicago time or Central time. But yeah, the DAX is sometimes a key tell as to what might happen just based on a divergence, where one market makes a high and the other one doesn't. Why is the question? Why did one make a high and the other one didn't? It starts to create a trade, no, but helps create a bias. That's one of my bigger bias creators, is relating markets to markets. The yen's real weak and we're usually strong. Why aren't we strong? It's because there's someone in there selling it and they're collecting a lot of people stuck long, and the price won't move up and whatever, and the yen turns around and we then break, and maybe I'm answering this too quickly, but that's what has to happen. That's my biggest bias creator relationship. So to answer your question, every market, not all of them are important. The bigger ones are. You don't look and watch all of them and trade all of them, but you have an idea of what's going on in case something pops and you're not aware of it. That's where a good trading room is important and helpful. It's not about talking about trades and opinions and everything. So it's about paying attention to what matters.
Callie asking about crude. He wants to know what size you consider to be large in the crude market.
It It varies 9 to 14 and up. You don't win an iPad for that either. But 9 to 14 and higher for the crude oil. Obviously, every market's going to have what's big and what's small relative to it. Oil's a good market because it's not super thin, but it ain't super liquid, so it'll move out. It's showed a lot of strength. Oil has almost been a little macro of a tell to S&Ps the last couple of days with the S&P sell-off. Oil stayed pretty strong. But yeah, anywhere from 10 or 15 and up, I'd consider big.
Okay, we're nearing the end. I'm just looking for questions that have not already been answered, so let me see here. Helder wants to know about using this on currencies. He's asking about spot, but you might want to comment on both spot forex as well as future currencies. Is everything going to be the same, or how does it differ?
He could email support@MarketDelta.com as far as the functionality of those markets on the Market Delta charts. To answer his question as to the usefulness of order flow, I would say anything that has price attached to it, right? So whether it's shirts, cars, houses, toilet paper, S&P, DAX, spot currencies, anything that has buyers and sellers attached to it is going to adhere to this cluster, right? And where these guys get stuck.
Right. The issue being, though, spot being deregulated and volume being more difficult. But if you look at volume, perhaps on the future side, might be one way.
Yeah, well, that's the thing is that I've never traded the spot currencies, and one of the negatives about it is what you just mentioned. You're not really sure if you're seeing the best bid offer and how it's not as transparent as the futures market. So there's always that, whether you trade it and try to read it. So when I'm trading or interested in currencies, I'm speaking to the future side, the 6J, 6E, which is the euro, the yen, and the ones on the CME.
Tim is asking, and I saw another question similar to this earlier. Looking at the footprint in Market Delta, is there some type? They're asking if there's some type of like an additional indicator that would go on top that would identify signals, or in this case, Tim's asking identification of what's considered a big buyer or seller.
Absolutely, and there's some that could be coded for those that come in, and there's imbalance user specified what you consider big size that paint a lot of different kinds of shape, and these are all included in the software, right? And they're all coded up based on making it as visible as possible. That's one of the bigger positives of having software like Market Delta is that it has all these components and dimensions already in it. So to make it as visible as possible, it has these paints that go on with imbalances that might be greater or less than anything you want. Big size that comes in at a specific price, it would highlight that. Being able to highlight hollow boxes around POCs for that specified periodicity. Drawing a profile just over a couple footprints and just looking at the footprint. So there's so many dimensions you take with order flow and tie it into a volume profile / market profile and run them side by side. And all of those are there's just a whole long list of user specified colors, shapes based on what you want to see and when. That's what the filter is for me. It's essentially an indicator, right? It pops up, it's a point of reference, and it's when bigger size comes in, and then I could change that, go from 200 to 100 to 300 and look at different sizes to see when they're reacting and what might be big and what not.
Right. Okay. Let's move to one final question here, and then I'm going to ask anybody that did not get their questions answered to just email Anthony or visit Market Delta's site to get them answered. Andrew asked one final question, and that is, do you have any type of a daily target or a daily loss limit that you stick to?
I'm going to type in my email address real quick for him,
okay,
and then I'll answer that. TradingRoomMarketDelta.com. All right, let me make sure this goes out. All right, so these are questions that might not be answered. Do I have a daily, could you repeat that, Mike?
Yeah, he's asking, Andrew asking if you have a daily target or a daily loss limit that you stick to.
Yes, but it's not, for instance, I talk in terms of ticks, right? Not necessarily P&L. Obviously, I relate it. It's just a way to trick your mind. And again, it's the lingo of guys who trade for a living. Like, how'd you do today? You don't tell them I made $800 or $2,000 or $3,500 or $1,100. You'd say you made 100 ticks. You kind of round it out, $10 a tick. That's essentially what the ES is. That's what most of these markets are. Made 500 ticks, made 2 ticks, lost 20 ticks. So it's all talked in terms of ticks. I look at it like this, and it's subjective. I never want to lose anything that's going to be above what my average week might be a good week. I'm not going to lose that in a day, or that's when I shut it down. I don't want anything to adversely affect my next day. I want my store to be open and business as usual the next day to minimize having yesterday bleed into today. Because every day is different, every day has different opportunities. So what might have worked yesterday is not working today, or vice versa. So I do have limits, to answer his question in short. Not upside. Upside is more subjective. I want my overall goal, Mike, and whoever the guy is that asked this question, is to create an above average living because we're taking risk. But that's subjective. What I advocate to those, no matter what level of experience you are, is to create an account that's sideways to higher, where you're able to participate and risk capital, and again, not be able to strip randomness out, but create a moving average that's sideways to higher. You look for the spikes, you're going to get them, and they're going to be south. They're going to be P&L equity spikes that dig into your account. Sideways to higher, if you're not consistent, if you've never been consistent before, sideways to higher, and you'll get the spikes once you're understanding what's going on. You try to hit a home run, you strike out. You just try to do the right thing, you get your base hits and everything. Sometimes the ball goes over the wall. But again, it's what you use, and it's this order flow, and it's just semblance of where the others are wrong. But again, the long answer was that. The short answer is I have a downside so I can keep a clear head, and my upside is to create an above average living than what I can make doing things that may or may not be secure, right? So that's kind of how the rationale for my limits are. But anybody that is doing this, we're all doing it for the money. Bottom line's the bottom line. So you want a sideways to higher account, and don't get disappointed when it's sideways if you're still participating. That's a good thing. And then you'll turn corners and everything else.
Okay, so for anybody that has not got their questions answered, you can email tradingroom@marketdelta.com or just visit their website, marketdelta.com, and I encourage you to do that. Also, for the those of you that want to watch the recording, I'll post it probably sometime tomorrow on YouTube, and I will email that to the Market Delta folks as well. So Anthony, once again, I want to thank you for your time today. And for those that have not watched the first webinar that Anthony did a few weeks ago on BMT, I highly recommend that you do so. I've got fantastic reviews from that webinar, so I think it'll be very well received. And also would like to invite everybody to participate in all the other webinars that are still yet to come for the remainder of this month. We have a lot more fantastic prizes to give away in those as well. So thanks, Anthony, and hope you have a good weekend, and I'll see you back here probably in a few weeks.
My pleasure, Mike. Good luck to all you guys.
Thanks. Bye.